I'm Sweder with InvestmentPitch.com in the offices of Jennings Capital with mining analyst Alka Singh. Hi, Alka.
Hi, thanks for having me on the show.
It's a pleasure. So perhaps you can start with an industry update on the uranium sector and the long and short-term demand.
The uranium sector, as you know, since March of 2011 has been in a slump, and this is because of what happened in Japan. When Japan had an unprecedented earthquake and a tsunami, 4 of their nuclear power reactors were affected, and that impact had a few radioactive substances leak out, and that's the reason why the uranium industry has still not recovered from that. It has been over 6 months and the industry is still suffering. However, if you look at the short-term and the long-term demand supply fundamentals, it still looks pretty strong for uranium. Out of 441 nuclear power reactors that are operating today in the entire world, we need about 180 million pounds of uranium just for those 441 nuclear power reactors which are operating. We are not accounting the ones which are in construction, the ones which are planned and proposed. And today, we produce about 130 million pounds of uranium. So there's a gap of 50 million pounds of uranium, which is currently supplied by the Russian agreement, the HEU agreement as it is called, which is the highly enriched uranium agreement. So Russia supplies for a large part of that gap which we need for our existing nuclear power reactors. So imagine when we actually build new nuclear power plants and some of the newly proposed and planned nuclear power reactors come online, what that demand will go to. So in 2013, the HEU agreement is expected to expire, and that's when I think that there's a huge gap between the demand and the supply of uranium.
So with Russia and Canada being the largest producers, can you touch a little bit more on Canada and what those districts are?
Sure. Actually, the Athabasca Basin produces about 20 to 30% of the total world uranium, and I mean that's one area which produces most of the world's uranium. The other countries that produce uranium are the US, but that's only a small portion, and Kazakhstan. There are some countries which are located in not that politically stable environments. They produce a lot of uranium as well. Australia produces a lot of uranium, Kazakhstan does, but then again, the pace at which the uranium supply is increasing is not enough to keep pace with the demand over the next 10 to 20 years, especially with China increasing their nuclear power capacity, India increasing their nuclear power capacity, South Korea is doing the same. And this increase in the nuclear power capacity from these countries is much more compared to Germany shutting off a few nuclear power reactors after the Japanese crisis. So what I'm saying is the demand is actually going to grow at a much higher pace than the supply is going to go for the next 20 to 30 years. So long term, uranium has very strong fundamentals.
So you mentioned the Athabasca Basin, Alka. What companies in that area are active?
Well, most of the larger major uranium companies are present in the Athabasca Basin. You have Cameco there, which is one of the largest uranium producers in the world. You have Denison Mines. You have smaller companies like Hathor. You have Fission Energy there with a joint venture with KEPCO. And you have a number of other smaller companies as well. So most of the well-known companies that produce uranium or that are looking or that are exploration companies are all present in the Athabasca Basin, because Athabasca Basin also is known for its high-grade uranium resources, unlike the US where it's mostly in situ leach or low-grade uranium deposits.
But with this correction, Alka, what companies are thriving in that area?
Well, basically in this kind of a volatile market, and especially the uranium sector, which is in a slump right now, investors generally are looking at larger cap companies like Cameco. However, due to the M&A possibilities and because most of the exploration and development companies stocks have actually been suffering, there's a lot of M&A opportunities as well. Cameco recently made a bid for Hathor, and a hostile bid for Hathor. So companies with great projects, good assets, and good management team are the ones that are going to thrive. So I would like to highlight Hathor and Fission Energy, which are in the area. And they both have great projects and good management team, and possibly both of them are M&A candidates.
Great. So what does this mean for share prices?
Well, basically, share prices of the larger cap companies like Cameco, Jennings, and Uranium One are going to be the ones that recover the fastest once the uranium price starts recovering. And the other side, the smaller companies with great projects and with assets that are very attractive to larger cap companies, a lot of speculation will drive their share price upwards as well.
Very good. Thank you so much, Alka. It's a pleasure to have you.
Thank you so much.
In the offices of Jennings Capital in Toronto, I'm Sweder.